together? The answer is a very good and high probability trading system. Trading pin bars at significant levels of support and resistance is one of the oldest trading systems around, but it's one that still performs extremely well today. It's easy to learn for beginners, provides a good number of profitable trading signals, and best of all, you only need to mark some support and resistance levels on a chart. Wait until the price reaches one, then see if a bullish or bearish pin bar forms. First, if price hits a support level and a bullish pin forms, you enter a buy trade. And second, if price tags a resistance level and bearish pin forms, you enter a sell trade. Let's go through a quick example. Here's a bunch of support and resistance levels I marked on a chart of Euros United States dollar. If you look to the right of the chart, you can see price has just fallen sharply and is now close to hitting the support level at the bottom. The line marked blue. If price hits this level and produces a bullish pin bar, it'll be a signal for you to go long. The pin forming at support suggests the banks and other big traders want price to rise. The support being a key point they would want a reversal to take place from, the pin confirming their interest at that level. And what happens next? A bullish pin bar forms. This pin bar confirms price has a high probability of reversing away from the support level. It doesn't mean price will definitely reverse and move away, but it does make it highly likely. So, upon seeing this pin bar form, enter a buy trade, place your stop loss slightly below the low of the pin, then see if price reverses. If everything works out as it did here, you should get into a nice profitable long trade. For trading resistance levels, you follow the same process. You wait for a bearish pin bar to form at resistance, place your stop just above the high of the pin bar, then see if price reverses. Very easy, right? Here are other examples of the pin bars trading at support and resistance levels. System number 2. Engulfing candles inside supply and demand zones. Trading engulfing candles inside supply and demand zones is an offshoot of the supply and demand trading strategy popularized by Sam Seaton. And it's one of the best reversal strategies on this list. There are two types of zone. First, supply zones. points where the price is likely to fall. Second, demand zones, points where it's likely to rise. And now, the normal way of trading supply and demand, the way taught by Sam Seaton, is to place a limit order at the edge of a zone, and then wait for price to, hopefully, execute it and reverse. However, it's much better to wait for an engulfing pattern to form inside the zone before entering. Engulfs form when the banks enter the market and conduct some kind of action, like place trades, take profits, and close trade. So, seeing one form inside a zone provides greater confirmation price is actually going to reverse. Here's how it works. First off, mark a few supply and demand zones on the chart. I recommend only marking the ones closest to the current price, so the chart doesn't get too cluttered. To draw the zones, again, I'm really simplifying here. Find the bottom of a sharp rise or the top of a sharp decline, and draw a rectangle from the open of the last small candlestick that formed before price jetted away to the most recent major swing high or low. Swing low for sharp rises, and swing high for sharp declines. With the zones marked, the next step to wait for price to return, and see if a bullish or bearish engulfing pattern forms within, or when price touches the outer edge. For demand zones, a bullish engulf must form. For supply zones, a bearish engulf has to form. In our case, a bullish engulf forms a few hours after the price hits the zone. The engulf confirms the price the banks want price to move away from the zone, making a great signal a reversal be about to begin. So now, you enter a buy trade and place your stop loss just below the opposite edge of the zone. If you're trading supply zones, it's the opposite way around. Wait for the price to hit the zone, and see if a bearish engulfing pattern forms. If it does, you enter a sell trade and place a stop above the opposite side of the area. Here are other examples of the engulfing candles inside supply and demand zones. System number 3. Trading pin bars at trend lines. This has been a staple price action trading system for decades now, providing high probability low risk entries into trending moves or big swings. It's extremely easy to trade too, and only requires you to follow 3 simple steps. First, draw a trend line on an up or downswing. Second, wait for price to return to the trend line. Third, enter upon seeing a pin bar candlestick form. The key thing to remember, which almost everyone gets wrong, is always draw the line on the swing highs or lows of the swing, not through the bodies of the candles. When you draw the line on the candle bodies, the points won't add up. Price will often reverse after breaking the line. or won't touch the line in the right place, not giving a valid signal entry signal if a pin bar forms. To ensure this doesn't happen, always draw the line on the swing lows or highs that make up the move. This will give you the right trend line and allow you to trade pin bars at trend lines correctly. Here are other examples of the trading pin bars at trend lines. System number 4. Pin bars and engulfing candles at Fibonacci retracements. Another great strategy, or setup I think, is a better name for this one, you should add to your arsenal of trading systems, is trading pin bars and engulfing candles at Fibonacci retracements.